it's July 8th, 4 p.m. here in Chicago on a very hot summer's afternoon. I'm Lyric Hughes-Hale, editor-in-chief of EconVue, which publishes independent views on the global economy from experts around the world, several of whom are joining us today. We're happy to welcome you to our webinar featuring David Maywald on the subject of ESG and sustainable investing. We've chosen this subject because tomorrow the International Energy Agency is having a ministerial level meeting in Paris on the subject of clean energy, which relates, of course, to ESG. Before the Q&A begins, here's the order of play. Dave will make his presentation, and after about 15 minutes, I'll invite other EconVue experts to respond individually. Marsha, Vande, Berg, Robert Madsen, who are both in the San Francisco area, and Nikolai Tagarov, who lives in both Beijing and Chicago. All have written about sustainable investing and will bring further perspective to our topic today. You can find their bios as well as Dave's on samples of their work on the EconVue website, econvue.com, by clicking on the Experts tab. So now on to the main event. I've known Dave Maywald since his time at Rare Infrastructure in Sydney, where through his research, he helped to build this innovative fund into an $11 billion powerhouse. His expertise is in portfolio management, sustainable investment, infrastructure, and economics, and he's passionate about his subject, as you will soon see. In light of the current unprecedented levels of fiscal stimulus around the world, he feels that now is a good time to invest in the future. But I will let him explain further. Dave, for those of us who aren't quite sure of the definitions of ESG and sustainable investment, could you give us a quick explanation before sharing your thoughts about the opportunity for a green recovery? And welcome to our webinar.
Good afternoon, everyone. And thanks so much to Lyric. I really look forward to the discussion with Marsha, Robert, Nikolai, and with all of you. And on the question that Lyric has just posed, certainly I bring a very expansive perspective of trying to appreciate the very wide range of environment, social governance, and overarching issues that apply to investments. And in terms of the scope of sustainability, my perspective is that it covers the very long-term period. Certainly, it covers social and environmental perspectives, and it also obviously, is important for financial and economic metrics. Most investors have a longer time horizon than one day or the next quarter's profitability. And most asset owners are fiduciaries, and they're managing money on behalf of member beneficiaries who might be retiring in 20 years' time, in 35 years' time. So they have a very, very long time horizon. Now, today, I'll give some context for why the United States should pursue a clean, green, and sustainable recovery. By the way, you can download these slides at LinkedIn in the featured section of my profile. During this session, I'll be drawing on my practical experiences across investment, economics, and sustainability. By considering environment, social, and governance issues, sustainable investment, and the multiple benefits of green recovery, I hope you'll appreciate the huge opportunities that are ahead of us. Political and corporate leaders are focused on the COVID-19 crisis, amongst hopes for a sustainable recovery from this recession. It's clearly neither possible nor desirable to return to the old normal. We must now strive to build back better. Balancing economic growth with sustainability and climate resilience is in focus for developed countries, and it's also leadership ambitions. Since the pandemic onset, there's been a growing international push for policymakers to use stimulus programs that are designed to help the economic recovery, as well as addressing social cohesion and our environment. Bloomberg NEF has tallied stimulus measures to date and found that they entrenched the unsustainable status quo, benefiting fossil fuel producers, thermal power generators, and transport companies, amongst others. Deutsche and Bloomberg find that only 5% of stimulus has been sustainable or green so far. Some of the hoped-for spending on climate change mitigation is instead spilling over to resilience and adaptation. The Paris Agreement may end up representing a best-case outcome of cooperation and limited global warming. A middle scenario of, say, 3 to 4 degrees of warming centigrade by the end of this century would necessitate very large adaptation and resilience spending over time. A survey of 231 central bankers and G20 officials shows strong support for climate-friendly measures. Green projects create more jobs, they deliver a higher short-term return, plus they lead to long-term cost savings for consumers and for business. Stimulus into renewables and energy efficiency creates 3 times more jobs than investment into fossil fuels, according to the World Bank, Oxford University, EY and McKinsey. Climate-friendly stimulus policies offer a far better mechanism for boosting jobs and growth compared to unconditional bailouts for high-carbon industries. Energy-efficient building upgrades and clean energy infrastructure investment have high multiplier effects. The Oxford University study called "Will COVID-19 Fiscal Recovery Packages Accelerate or Retard Progress on Climate Change?" identifies 5 policy areas with high potential on both economic multiplier and climate impact metrics. These are clean physical infrastructure, building efficiency retrofits, investment in education and training, natural capital investment, plus clean R&D. Here's my personal assessment of where some of the key countries sit on sustainability and emissions. I'm certainly keen to hear your views and perspectives on this ranking. Unfortunately, the current sustainability leaders are extending their lead while the laggards are still lagging. This fails to take advantage of the many easy wins in Australia, the United States, Canada, Russia, Asia, and other countries. Removing bottlenecks and increasing the investment opportunity set will be met favourably by the market. We have abundant opportunities that are backed by voters and evidence, such as renewables, building efficiency retrofits, power grids and batteries, and there's a huge amount of money out there that's looking for a home. There really is no comparison between the political leaders in Europe and the US or Australia when it comes to sustainability. At the national level and at the European Union level, they just get it. Plus they're implementing and following through. The European Commission President promises to put their Green Deal at the centre of the EU's recovery plan, pushed along by a very broad Green Recovery Alliance. 1/4 of total EU spending will go to climate initiatives. Outside of Europe, sustainable recovery packages are generally shaping up as less aggressive than climate advocates had hoped for. Opportunities for systemic shifts have not generally been taken outside of the EU. The UN COP26 Glasgow Summit was the deadline for nearly 200 countries to announce their updated emission cutting pledges. With the climate convention having been postponed by a full year to November next year, there's less immediate pressure to speed climate initiatives now. The EU has comprehensive work streams across all areas of sustainability, and they aim to deeply embed a green recovery across the continent. This includes using their taxonomy of sustainable finance to guide which activities will be supported. They are deploying all policy levers to deliver their Green Deal, with leadership across disclosure, carbon, investment stewardship, and taxonomy. They have the most advanced and abundant suite of ESG regulatory measures. Wind and solar generated more electricity than coal did last year across Europe, with coal-fired generation plunging 24%. Last year, they saw the biggest declines in emissions since 1990, and this year they'll be substantially lower again due to recession. When large-scale investments are necessary, and we're talking tens of trillions over decades, along with stranded asset risk for prior investments, mass retraining, and the creation of new business models, it's going to take more than nudges and small price signals to change entrenched behaviour. ECB President Christine Lagarde has today opened the door to using its €2.8 trillion asset purchase scheme to pursue green objectives, promising to examine changes to all of the ECB's operations in the fight against climate change. She suggests that the central bank may have a green bias in its stimulus policies going forwards. This is the first time that the ECB president has committed to examine green changes to all of the bank's operations, including asset purchases. And it would mark the ECB as the first main central bank to use a flagship bond buying program to pursue green objectives. This morning, the UK Chancellor announced the Green Homes Grant. Their government will provide at least £2 for every pound spent on making homes more energy efficient, capped at £5,000 for most households, but up to £10,000 for low-income households. Britain has proposed an accelerated take-up of green technologies, saying that it could have a profound impact on our society's future sustainability, resilience, and ultimately well-being. Decarbonising their economy will require one of the fastest and largest retraining programs the country has ever seen. Jacinda Ardern's government will support 11,000 nature-based jobs, including regional environmental projects to conserve and manage waterways, control weeds and feral animals, restoration, regenerative planting, and maintenance of public conservation lands. Canadians are much more likely to support specific green job and recovery measures than they are to back more general calls to address climate change through post-pandemic economic stimulus. There are many similarities between Canada, the United States, and Australia in terms of high energy production and usage, climate change politics, and the challenges of structural adjustment. China is the world's largest maker of solar panels and electric vehicles, and the country controls much of the world's supply chain for producing lithium-ion batteries. Long-term industry policy has allowed them to benefit from the renewable energy transition in other countries. Large investments from government and companies have built this industrial capacity. The Politburo Standing Committee defines new infrastructure priority areas to include ultra-high voltage power transmission, high-speed rail, and EV charging infrastructure. However, the use of funds from local government bond programs suggests that there's been a continuation of the traditional Chinese approach rather than a green pivot in recent times. 87% of Chinese people see climate change as serious a threat as COVID-19. The South Korean president has explicitly referred to the European Commission's Green Deal as instrumental in the formulation of their Korean plan. Bilateral meetings between South Korea and EU officials have enabled the two regions to share policy ideas and form cooperation projects. There's a broadly held expectation that government and corporate responses to the recession will be more sustainable, environmentally friendly, and socially aware than in the past. The ESG hurdle is being lifted every year. Consumers and voters have a much higher standard than they did during the global financial crisis. Some overseas stimulus programs have been unavailable to companies that make use of tax havens or that have bought back their stock. There's a very broad coalition of business, unions, investors, green groups, workers, and voters that are calling for a sustainable recovery in Australia, with support for energy efficiency, renewables, smarter control systems, improved energy management, distributed generation, and energy storage, such as batteries. In particular, energy efficiency and retrofitting existing buildings are both highly job intensive, which is just what we need right now. All of the states and territories in Australia have signed up to net zero by 2050, but not the federal government. And they're all supportive of increased renewable energy, distributed generation, battery storage, emissions reduction, local manufacturing, boosting jobs, as well as developing green industries such as hydrogen and steel. According to a World Bank study following the GFC, $1 million invested into the United States oil and gas industry creates only 5 jobs, compared to 17 jobs per $1 million invested in energy-saving building retrofits, 22 jobs for mass transit, 13 for wind and 14 for solar, 3 to 4 times more compared to fossil fuels. Tax credits have been switched on and off in the past, and the fulfilment of Australia's renewable energy target has caused a large decline in large-scale renewables installation, quite disruptive for that industry. It went into overdrive for 2 years, and then it's plummeted by 50 to 70% in the subsequent year. The development of sustainable jobs requires long-term signals, supportive policy, and stability. Communities now are demanding a greater amount of local content. They want to see long-term skills development and training programs. Local manufacturing of solar, wind, batteries, and electric vehicles offers a counter to China's domination of the clean energy transition. As Lyric mentioned, the International Energy Agency has released a sustainable recovery plan last month, which projects a boost to global GDP of 3.5%, the creation of 27 million jobs over 3 years, and putting carbon emissions into structural decline. This plan would see 2019 as the peak in global greenhouse gas emissions. This plan will be discussed by world leaders in Paris tomorrow. Nearly 2/3 of respondents in 14 countries said that it was important that government actions aimed at economic recovery prioritised action on climate change, from an Ipsos Mori poll in April. This included 57%, a clear majority of Americans that were asked. US polling finds majority support for $1 trillion investment in green technology, with 20% more support for a Green New Deal than opposition to it. As you can see on this slide, there's majority support among Democrats, Republicans, and Independents for a wide range of public green investments, from renewable energy to electric vehicles, underground high voltage transmission, smart grid technology, retrofitting buildings with an emphasis on low-income housing, as well as battery technology. Trump's administration has aggressively pursued a deregulatory agenda and even bragged about the removal of environmental restrictions. The GOP has taken an ideological approach to some aspects of energy and climate policy, entrenching the deep political divide. Politicising the fear of job losses has seen some states reopen too quickly, with the desire of returning to normal, and this has had disastrous consequences. Some politicians, while others selectively listen to scientists and experts when it suits them. It's a curious inconsistency. You pay attention to public health experts about a pandemic, but not to climate scientists about global warming. Climate and social policy experts have called for at least $2 trillion of green stimulus, automatically renewed at 4% of GDP per year, roughly $850 billion until the economy is fully decarbonised and the unemployment rate is below 3.5%. Most voters strongly support a sustainable recovery. Most businesses benefit from sustainability, and research strongly supports the job gains from green investment. There are many profitable investment opportunities and employment from the transition pathways to net zero. Countries and companies that have been first and second movers are currently benefiting at the expense of the laggards. Please connect with me and make a positive contribution to this space. There are plenty of business, work, and research opportunities that you can pursue while helping people and protecting our planet. I've recently shared a range of LinkedIn articles expanding on economic growth, extreme monetary policy, corporate reporting, and climate change. Plus, I'm happy to engage with you on your projects and opportunities, and I look forward to the discussion.
Thank you very much, Dave. That was great. And, it really your presentation leads me to ask Marsha a question. The U.S. seems to be laggards in this space. And Marsha, where do institutional investors fit in? It looks like there's popular support, but some political division on this issue. How do you see this from, where you sit? So Marsha, let me unmute you.
Yeah. Now can you hear me? All right.
I'm good at this. Okay.
I was muted at this end too. So.
Okay.
So thank you for that question. I think there's no question that the U.S. is a laggard on this front. And what the EU is doing is really setting the pace. And I was encouraged by what Dave said about the South Koreans, if I understood him correctly, that they see what the European Commission is doing and the EU more broadly as a result of their green policies. But, and I think Dave is exactly correct. There's been an ideological approach to anything having to do with E, maybe less so with S and with G, but certainly with the whole climate change front. And their agenda has been deregulatory and being proud of pulling back on anything that has to do with energy resources. But I think, we're looking at a presidential election come November 3rd, and recently the Democrats did put out a green policy statement, which they intend to take into the convention with them, that has an emphasis on electrical companies, the electrical provided sector, and requiring their dependency on renewables to increase and to be total by 2035. It's also got a focus on vehicle emission standards and 2 or 3 other positions. So it's a start, but it's a very deep and specific contrast to what we've seen the last 3.5 years coming out of the Trump administration, and in contrast to the 8 years prior to that, the Obama administration. So I think the policy front is really an interesting area in this whole discussion about sustainability to be watching in the very near term. The discussion in Paris tomorrow that the IEA is putting together is really one of the first public discussions to get underway. And I think they are trying hard to put the policy issues firmly on the agenda and with a higher profile. And while this is happening on the policy front, and it's being centered really in some places and not in others, there has been a really deep and significant driver for sustainability coming from the institutional investment community. And this is by and large the large public pension funds. There are some corporate funds that are part of it, sovereign funds, and I think the funds in Australia have been significantly involved in sustainability investing as well. And it has, for the past 5, 6, 7 years, so the preponderance of the movement has focused on the E of ESG. So E for environment, focused on the climate change. And it's been COVID and the pandemic that has pushed the S issues up to the forefront of their interests. But by and large, they've been focused on climate change, and now S, and G, if you will, has always been part of what their focus has been. It could be you talk about ESG factors in terms of governance equals E and governance equals S, but that's a discussion for perhaps a later day. But from where I sit, these asset owners, the large institutional investors, are really at the apex of the investment community in terms of sustainability. And Dave, you've written as much, at least what I've read of what you've written. I listened to a YouTube of yours too, I think this morning. But these asset owners are key players in the whole field, and they are buttressed by certain organizations that are advocacy organizations like the United Nations supported Principles for Responsible Investment, the PRI organization based in London. It has a significant number of signatories to its principles for investment. These principles hold investors to account for what they do on the sustainability front, how they go about setting up their own investment strategies, and how they organize these strategies for the managers who are entrusted with their investments. So it's two-pronged. It's both in terms of their direct investment strategies and then how they work with managers. The PRI has been a very important organization providing tools and encouragement to the individual funds that are signatories and the corporations that are also signatories. It's a cornerstone organization in the movement that has pushed institutional investment, responsible investing into this mainstream that by some count now totals $31 trillion in managed assets. That's a lot of money. Public pension funds, some corporate funds, sovereign funds have been really the spear carriers in this drive on behalf of sustainability into mainstream investment strategies. And going forward, they'll remain significant players, even as the policy debate rolls out, but they'll remain significant players, not to be backed up because of COVID, because of the pandemic, and because of an argument that there should be a renewed emphasis on getting corporate balance sheets in order, getting growth back on target before we talk about green. They are going to be saying green is part of the solution, not ancillary to the solution and an aftermath to the solution. You can look at these investors, these pension funds and sovereign funds and so on, as really value investors. So in contrast to what you might think of think of responsible investors being values investors, investing by their values, these investors I'm talking about are really driven by their fiduciary responsibility, driven by what they see as their role as stewards to invest for the long term. So you'll hear them talk about being long-term investors as opposed to being values-driven investors, long-term investors with risk in mind. So if you think about climate change and in terms of risk, that's got a long horizon in terms of what its implication is going to be. And these investors they have long-term horizons. They're talking about 30 years out. So if you are a company and you are intending to be competitive now as well as 30 years from now, and you want these investors to remain as shareholders, you're going to be looking at the implications of things like climate change and now the implications of the S issues, the stakeholder issues or the social issues as a result of what we're seeing in COVID. I think it's a really significant development. Just on the issue of climate change, I wanted to make a point that as an illustration of how corporations are starting to get with it in terms of climate change and in terms of sustainability. A decision by the boards of two major oil companies, BP and Shell recently, reflect this acknowledgement that there is indeed a trend afoot. So these institutional investors have picked up on it. These companies are now acknowledging that this trend is afoot toward a diminishing of the carbon footprint. And so to get ready for that, to position themselves to remain competitive over the long term, they are pulling back, saying they're going to reduce their carbon footprint in both their operations as well as in their products that they sell.
Marsha, that's a perfect segue to what Nikolai is going to talk about. So I'm going to join those two pieces together from the point of view of energy and also Europe. So Nick, I've unmuted you, I think.
Yes, I'm here.
Okay. All right. We'd love to hear your perspective.
So my questions were let me just briefly introduce myself. First of all, I have been consulting the European Commission and various European governments, such as the Bulgarian government, my native country, Bulgaria, the Norwegian government, and other governments in Europe on sustainability. I have, in addition to my work as a policy consultant, mostly with the European Commission, I have also independently worked on renewable energy projects around the world, typically with Chinese investors. Those are the origin. This is the origin country, typically China. The projects all over the world. And my questions were actually not so much about Europe. I'm aware of Europe as being the leader in the field. What is more interesting to me, since I am now based in Chicago and I've been away from China for a while, I used to consult the biggest investor in renewable energy in Eastern Europe, EBRD, on their China policy. But I've been away from that kind of work for a while. My interest really is, and what I'm questioning is the impact of the pandemic and the strained relationships between China and Australia on this relationship, the China-Australia relationship when it comes to sustainability. I guess there must be some impact on, let's say, green investments from China into Australia, but also perhaps greater scrutiny of certain other investments which are not as sustainable. So I would love to hear David's view on this.
Okay, well, thank you. So we're going to ask David to respond to the responders after Robert Madsen has had a chance to give more of a geopolitical point of view.
Thanks. First, a little bit of an introduction. I've spent most of my career working as an economist and an investment strategist. In the last few years, I've been working closely with the Ford Foundation to develop an ESG strategy that they hope to promulgate among institutional investors. I'm also working with Stanford Law School on possibly starting a program in ESG investing. I'm going to make a few preliminary comments, and then there are 5 points that I want to touch upon. The first point is there's a danger in this discussion of focusing on the leaders and ignoring everybody else. And by leader, I mean Europe, essentially. By everybody else, really the only countries or the only categories that really matter are the United States and China and the third world, developing world. The U.S. obviously is moving in the wrong direction. Trump administration has pushed the United States away from the agenda we're describing. Even if the Democrats take power, it's going to be very difficult to roll a lot of that back. It's going to take years to go. With China, yes, China is leading in some forms of energy efficiency. The problem is that they're doing that for entirely selfish reasons. If you plot out China's energy demands, they're going to have extremely high demand for hydrocarbons. They're trying to reduce that, but it's on the margin. And secondly, that's not really part of an international movement. In effect, China's trying to redefine the international norms in their own way, and they see the West as an enemy in that regard. So I think those are important things to remember. And the other issue is that all the projections and things that we're doing, I think they have to be taken with a grain of salt because of things which are happening more broadly. The problem of populism in many countries, particularly the United States and the UK. Secondly, nationalism. I don't think, for example, that we can ignore Hong Kong and the implications for Southeast Asia, where countries are going to have their priorities set when we're talking about ESG investment and sustainable investment in general. Those things are on top of a table. The table has been shaking for a number of reasons. But having said that, there are 5 quick points I want to touch upon. First is the genesis of this movement. two ways of looking at this. One of those is kind of the European way, which is to say societies are falling apart at the edges, which I think is true. The environment is in real trouble. Therefore, we need to change the way businesses operate. Everybody agrees with that. Europe has taken it fairly far. There's a second motive, however, which I would call terror. If you're running a corporation or investment firm looking around the world right now, particularly the United States, but also the UK and some other places, populism is destroying institutions right and left. If you include the additional factor that there are people like Elizabeth Warren waiting in the wings, companies are looking and they're seeing angry people, reformist politicians, and they're trying to preempt that. I don't for a minute believe that the Business Roundtable in the United States would be taking ESG investments seriously if they weren't really frightened here. So I think it's important to remember that fear is a motivating factor here. The second point I wanted to touch upon is there are real limits to what ESG investment can do. One way to look at that is market efficiency. If you believe that markets are efficient and you have a large institutional investor who decides to sell off kind of sinful stocks, the stocks of sinful companies, somebody else from India or China, the socially neutral investor, is going to step in and buy those. There will be no net effect on pricing in the market. That's true on the long side and on the short side. If you go to private markets, it's a little bit different. You obviously can't short a company that's not publicly available, but you can find companies that are expanding and you can buy equity or offer them better terms if you like what they're doing. But frankly, the realm of companies that can be affected through an ESG agenda is quite narrow. It's also important to note, again, that a lot of the problems that the ESG movement is being asked to solve are vastly bigger than corporations can handle. For example, big corporations that would be affected by kind of sustainable investment agenda among institutional investors account for, somewhere around half of the U.S. labor force. You can't ask those companies to improve worker conditions across the board. They simply can't do it. Nor can they undertake the burden of fixing the global economy. So, in terms of economic or environmental destruction. So I think it's important to remember that really, and here I'm anticipating a point I'm going to make a little bit later, really governments have to do this. The third point, natural resources. I've spent a lot of time working in particularly energy industries, but also in mining and materials. And the truth is that here price is what matters. Nothing else matters. If you look at the first oil shock, when the price of oil skyrocketed, the effect of that was to cause the OECD economies to improve their energy efficiency by about a third. So oil prices were driving that. If you look at what's happened in the last 10 or 15 years, again, when the oil price goes sky high, you get much more investment in things like alternative sources, also better utilization of energy, etc. But what we're seeing right now is the opposite. The oil price has collapsed. A lot of the innovation in the industry has just gone away. The Dakotas are effectively in depression. So if the global economy is in really bad shape, I don't think we can expect people's interest in environmental technology to continue at its recent pace. The bottom line is that depression is good for the environment because it means there's less carbon consumed, but it's very bad for the future of energy technology development. A place like China will continue to invest in this stuff, but I think it becomes much more difficult globally to organize things. Fourth point. I hinted at this before, but these are things really governments have to manage. Whether you're talking about workers and their interests, national health care, pension availability, whether you're talking about conditions for workers or environmental rules, corporations are a small piece of this puzzle, and investors, frankly, are a small piece of the puzzle. Ultimately, this comes back to governments. My fifth point, if what I've said sounds highly skeptical of sustainable investment, I'm going to suggest that sustainable investment is very important for a series of other reasons. One, if investors and corporations get together and they enshrine certain principles in their codes of conduct, that stands as kind of an indicator of where society's leaders are putting their emphasis. That does have an impact on people's thinking, and I think that's important. Secondly, and this is, I think, critically important, you really can get government attention if the corporate sector organizes. Now, of course, in the United States, people are focused on COVID, they're focused on the depression that the world is now in, etc. So getting people to focus on environmental protection is going to become more difficult, not less. But I think corporations can make a change, especially if they look at this as a problem of 20 or 30, 40 years. Getting this to the front of the agenda is something that politicians sooner or later are likely to take seriously. And then most importantly is the battle for international norms. China is trying to redefine norms for accounting, law, regulation, everything downward. If Europe, the United States, and Japan can get together and push a more aggressive agenda, a more positive agenda, they can influence the global balance of power in a significant way. So my conclusion is simply that corporations can make marginal differences, but the biggest bang is going to come from influencing governments and influencing the development of international norms.
Robert, thank you very much. I'm going to now let Dave respond to the three commenters. And there's a lot to chew on there. So I'm not sure where you want to start, but please go ahead.
I think for the large part, Marsha and I are probably on the same page, and I'd reiterate a lot of her comments. And I think that perspective of asset owners is very powerful. Robert's right. Listed markets, corporations, institutional investors, they're a piece of the puzzle. A piece. They're not the puzzle. The planet. That's the puzzle. That's what people care about. That's why we care about the planet that our kids and grandkids will be living in. And look at the comments from Christine Lagarde in her Financial Times interview, mentioning that the ECB will now review all of their operations to see what they can do in the fight against climate change. And she says, I look in the eyes of my grandchildren and I'm trying to answer the question from them, how did you get us into this mess? And what have you done to make it better? I think Nikolai's question is fantastic. It's very timely. I mean, down under, we benefited hugely from China coming out of the global financial crisis. The stimulus programs that they put in place coming out of 2008, 2009, and also out of 2015, 2016 were very beneficial to Australia. And, Australia ships up a lot of iron ore, a lot of coal, a lot of gas now to China, raw commodity products that they take and transform and add vast amounts of value add. They employ, their workforce in, some medium income, but highly value-adding jobs, manufacturing and transformative jobs. And then they sell those outputs, in solar panels and wind turbines and consumer goods and all sorts of things to other markets around the world. But also they consume Australia's resources to build the apartments that are sometimes empty in the past and to build the physical infrastructure. So there's an interdependency there. I think, strategically, Australia's more at risk because, we have a huge net trade surplus with China. We don't just depend on them for exports of our goods. We also depend on them for the students that have come down here to study, which now that business has been destroyed by COVID. The international students in Australian universities were dominated by Chinese students. China had been the biggest source of growth in tourism to Australia. And until, 2-3 years ago, when foreign investment got a lot of scrutiny, they were a massive foreign investor. So virtually every channel, was flowing from Australia. All those things have been turned off now. So Australia won't benefit coming out of COVID in anywhere near the same way that we benefited coming out of the global financial crisis. I think, as a smaller country, as an exporting and open country, we're at risk from that support not flowing. The economy, the future of jobs and government coffers is all at risk. What alternatives do China have for iron ore? There's Brazil. They've had problems with actually an ESG issue. Dams bursting, killing people. Now, look at the share price reaction to when you've got a dam that has burst through a valley and destroyed a town. That's an environment issue. It's a social issue. It's an overarching social license issue. It's not just confined to E, S, or G. It's all of them, and it's overarching as well. When companies aren't paying attention to ESG, it's financial, it's real risk. They get lawsuits. They can go out of business. They get suppliers that stop working with them. These issues are hugely material, hugely important for execs, and they are increasingly inside remuneration packages. What are the other alternatives? I mean, gas, there are other sources. China buying US fracked gas would be a little bit ironic in the current environment. In terms of seaborne coal, Australia is a big exporter of seaborne coal. That's a dying industry. I wouldn't put my pension money, and this isn't a personal investment recommendation, I'm just telling you, I wouldn't put my money into thermal coal exporters from Australia to anywhere. It's a dying industry. 117 banks, insurers, and export credit agencies have reduced their business with fossil fuel producers. Some of them blanket, some of them focused on coal. There have been $14 trillion worth of divestment commitments from over 1,200 institutions around the world, including some very large pension funds like Norges. $14 trillion. And there is something I wanted to show you relevant to Robert's comments. And this relates to, the impact of divestment and what happens when such a large, number of investors stop providing funding to a specific industry. So this is data from the International Energy Agency. What it shows you on the left-hand side is fossil fuel producers, and the dark line is their cost of equity. So this is the required return.
Dave, we don't see it at this point. We don't see the slide.
All right.
Yeah.
Could you push that through, or it says that I'm sharing here.
Call for sustainable investments.
Okay.
Got something to tell me?
Are you seeing it?
What's up?
Okay.
You see those two charts?
Okay.
What day is it?
Saturday the 1st.
We're going to be in LA.
We're hearing somebody talking. I'm not sure who it is.
Can you see those two charts?
No.
I'll try one more time.
Okay.
So I'll talk through it. Since 2006, the cost of equity for oil and gas companies has gone up from 9% to 12.5%. That's the required return that equity investors have for oil and gas producers. So it's increased by over 3%. And that's as debt costs have been plummeting. The cost of equity for top power companies with a large amount of renewables in their asset base has fallen from 9% to 5%. So that's a big dispersion. You've got oil and gas producers with a higher cost of equity and power and utility companies with a lower cost of equity. And the gap on the most recent data from the IEA was 12.5 down to about 5, so more than double. And you are seeing, changes in the register of large energy producers. For example, Norges has already started divesting. They've divested a couple of Australian companies, and they intend to divest further over time. We just had one of our largest pension funds in the country last week, Hester, announced that they would be divesting all thermal coal and moving towards net zero by 2050. So, I would think that if 117 banks and insurers are saying they won't do business with coal miners, thermal coal exporters, that reduces their options. And you can see this in the Adani coal mine in Queensland, which would be one of the largest thermal coal exporting mines in the world. They have massively struggled to get underwriters, to get insurance for their business. The Australian banks aren't providing finance to them. It makes it much tougher for them to get those projects across the line. So I would take issue, with Robert on some of those comments. I think divestment, and I think, the very quite aggressive moves by financial services companies are making a difference.
Okay. Well, if you look at this from 100,000 feet, and you think of ESG as off balance sheet, kind of, it is off balance sheet for most companies. But look at the environment. If you expand the environment to mean the healthcare environment and also the pandemic, and if you expand the social implications of the populism that Robert was talking about, companies have been incredibly hit by all of these factors. Think of all the brand issues, think of the employment issues. The things that hit people hardest this year were ESG, not anything else. Otherwise, we would be in a completely different place than I think we are right now. And then look at the companies that are succeeding beyond our wildest expectation. They're Tesla, for example. And Tesla is about all of these things. So this is really important. I'm not sure how it plays out, or if government or corporates, but it seems to me it has to be everybody working together. And I'd like to open it up now to questions. And if I don't get a question, Robert would like to reply to you. Okay. So Robert, I'll let you do that in the meantime, and let me unmute. Okay. Please go ahead.
Yes. The question is whether cost of capital changes are driven by institutional investment decisions. I have not seen the data that you're describing, and hence I don't know what time frame it is or what the driving forces are. I've seen a lot of other arguments, including by McKinsey, trying to say that the ESG investment drives improvements in profitability. Most of those are not actually very good studies. The best study to date is the one done by Mark Wolfson, Gilson, and Dean Paul Brest from Stanford. They've done detailed look at this and found what one would expect from the efficient market hypothesis, which is that these broadly traded corporations are not affected by the actions of even a significant group. Really what matters is the marginal investor. Even if 80% of your stock is held by institutional investors, even if 90% is, they should not be able to affect the price. So I would suspect that there are other factors here, but I can't say that with certainty because I can't see the data.
Okay. Glenn Aronson, let me unmute you. And you'd like to make a comment. Thank you. Thank you, Robert.
As a matter of introduction, I happen to work for one of those four-named pension funds in America. If I take Marsha's numbers correctly, we are about 1/3% of your 31 trillion. So that makes us about 1/300th of what you're talking about of institutional investors. We are extraordinarily focused on ESG, almost to the fact that it is more important than making money. Now that's an interesting comment, but we happen to be a very well-funded pension fund, so we don't have to be as concerned about making money as we are with some social issues, which is a nice place to be. I don't think there are many state pension funds in America that are fully funded as we are. But to my question, I don't see real change coming without a connection between shame, fear, economics, taxation, and government. Case in point, I happen to live in Amsterdam, and you all see everybody here riding on bicycles. Well, you can ask yourself, why do people ride on bicycles? Well, we have the highest annual car tax to own a car. We have the highest tax on gasoline consumption. And the parking in front of my house costs $48 a day. So guess what? You ain't going to have a car, right? And that is the way to truly change the world, in my view, because without economics, you can say everything you want, but until you tell people that it's going to cost them eating out, having a six-pack of beer, or God knows what, they're not going to change. I've watched our pension funds sell assets in non-environmentally friendly industries. And guess what? Somebody buys them. Somebody continues to run them. They run them cheaper than what the ESG-oriented assets do. And it doesn't change the world. Now, if there was a tax on that, as if, David, there was a tax on coal, and I'm not talking about a sweeping one-day tax. I'm talking about put the tax in over 10 years. Give people time to change. Okay? Go to America and raise the gasoline tax $6 a gallon at 50 cents a year or at $1 a year. Trust me, we would change. Okay? I mean, you would have to, you can't afford not to. So, and the last piece of why this taxation idea rings to me is, needless to say, COVID's costing every single government on the planet an immense amount of money. It's only a matter of how we're going to be taxed. Well, guess what? Tax us this way. Instead of doing a pull idea, which is what all of these policies are, pull people to do something. You know, pull can only take you so far. I vote for push. Okay? If it's costing me $9 a gallon to buy a gallon of gas, I'm going to think a little bit more about getting in my pickup truck that's enormous and eating gas because I just can't afford it. So again, I look at it as shame through real statistics, fear, another word you all brought up, taxation, and all driven by government. I think that is the push that's going to get us to where we need to get to. Thanks.
Okay. Thank you, Glenn. So we're now in the realm of behavioral economics, I think. But there's been a really broad divergence of opinion, it seems, on the subject. I think, as I said, in our next newsletter, we'll present some of the slides to Dave that you weren't able to present to everybody. And I'll ask everyone to, add some brief comments to it. And hopefully we can continue this discussion. I think if everybody had agreed, this wouldn't have been a good webinar. And I really appreciate everybody's contribution. So Glenn, thank you. Thank you, Dave, Marsha, Robert, Nick, and our tireless managing editor, Ying Zhan, without whom EconVue could not function. Thank you, all of you, for joining us today. I hope that you learned something that you didn't know before. You have a different perspective somewhat than an hour ago, and that you'll continue to support us through our newsletter and on our website. So we'll be posting an edited version of this webinar along with all the comments. And please contact me directly with any additional comments and questions, and I would be glad to put you in touch with any of our experts. So we're trying to end a little bit on time, and I think this conversation could go on quite a bit longer. But thank you for today, and maybe we'll have a part 2. So have a good day, evening, or morning, depending on your time zone. And David, particularly thank you for such a great presentation.